All right, so now we're going to start our lectures about capital gains. And we've talked about these before. We've distinguished capital gains from business income, capital gains from property income, things of that nature. We've said that a capital gain results first, we have to have a disposition. And that disposition essentially has to be of a capital asset. And we've said that a capital asset is an asset that was purchased to use. And again, you look at the various facts that would indicate the purpose of the purchase and so forth and so on. Now, you want to realize that the tax treatment of capital gains has been favored from the beginning of the Canadian tax law. Prior to 1972, the capital gains were tax-free. You couldn't, you didn't have to pay tax on any capital gains. And then after the various tax reform and tax study, again, the government wants revenue, capital gains started being taxed, but they've been taxed at different rates. If you read in the news, it's not at all uncommon to see the government debating taxing them at, changing the inclusion rate from 72 to 87, the inclusion rate was 50%. 88 and 89, the inclusion rate was 2/3. In 1990 to February 27th, 2000, the inclusion rate was 75%. And then from February 28th, 2000 to October 17th, 2000, it was 2/3 again. And now after October 17th, 2000, it is back to 50% inclusion. And of course, that means 50% or whatever the amount might be tax-free. You can write this in your act. It's in there in the notes, but it's really fine print. So if you want to, in the end pages of your act, if you would like to put that information in there, you need to feel free to do that. That would not be academic misconduct. All right. Now, to have a capital gain issue, we do have to have a disposition. I lay that out in the slides. A lot of this, I'm going to let the slides stand on their own. The capital gain slides are there, and I don't really have anything else to say. I don't want to just read these to you. So you have a disposition, which means you have proceeds of disposition. All right. And in some cases, you would have deemed proceeds. This, again, we talked about selling at less than fair market value or something like that, that the government will treat it as fair market value. And your gain or loss is going to be the proceeds of disposition minus your ACB on the asset equals your gain or loss. What this means is the adjusted cost base is a critical number. And adjusted cost base follows logic. There are a lot of detailed rules that tell you how to calculate the adjusted cost base, but it is going to follow your logic of what it would be. We've said from the beginning that we need to be fair, equitable in designing tax law. And one of the aspects of being fair is ability to pay. And in related to that, no double tax. So whenever we have a sale, the government would have a choice. They could tax the gross receipts, or they could tax the receipts minus the amount invested, i.e. the adjusted cost base. That is the amount that has already been taxed. That is the after-tax amount that you had to earn money to pay, then paid tax, then took the after-tax amount and invested it in some asset that you're now selling. Now, by the way, there are countries that tax on gross receipts, but the tax rates are very low. It's almost like a sales tax, and it's just they're undeveloped countries, so they don't have the infrastructure or the mechanism to have a sophisticated tax system. So there are, it's exists, but not what we would call a sophisticated tax system. All right, so that ACB is a critical piece of information. And again, it will be that after-tax investment that we don't want double tax. We need to reflect the idea of ability to pay. Now, there are a number of different types of assets that have some different rules that go with them. Your basic investment asset, you bought stock, something of that nature. The only thing you'll need to worry about there is measuring the adjusted cost base. And you'll probably use a pooling, which we talk about in another lecture. But we also have personal assets. Remember, to have a capital asset, you have to have an asset you bought to use. Well, that's pretty much the kind of essence of a personal asset. You bought it to use. So what happens here? Well, it is a capital asset, but we need to understand that so a capital gain on a sale of a personal asset would be taxable. A capital loss is not deductible. Why not? Well, because it's considered a personal loss. In other words, it's actually a loss from using up the asset. And using up an asset is reflected as depreciation. And there is nothing in the law that allows a depreciation or a capital cost allowance deduction for a personal asset. In fact, if you look in Section 8, it specifically says no deduction for personal. All right. So essentially, that capital loss is considered to be a using up loss, and that's a personal expense, and personal expenses are not deductible, but the gains are taxable. Now, we do, though, have an administrative issue here. I mean, we all drive by and see the garage sales. The cost and proceeds of disposition in a lot of cases are too small to bother with. All right, you have a garage sale, you bought something, you quote, used up some of it, and now you're selling it for $3 at the garage sale, and somebody comes in and offers you a quarter and you take it, etc. So what the tax law does is give a provision that the deemed proceeds of disposition are a minimum 1,000. Now, it might be 5,000, it can go higher, but minimum 1,000. And the deemed adjusted cost base is a minimum of 1,000. So for all those miscellaneous items, nothing really happens, because if you paid $20 for it and you sold it for 50, well, it's deemed you paid 1,000, deemed you sold for 1,000. There's no income attached there. So for the most part, minor odds and ends will not be subject to tax if they're personal assets. All right. Now, there's an exception to that with something called listed personal property. Listed personal property is personal property that is personal. You bought a painting, or you collect some particular item, you collect coins, things of that nature. So it's for you to use personally. You didn't buy it to sell, but it has an investment or a potential appreciation element to it. So number one, it has to be listed. If it's not listed, it's not listed personal property. And for listed personal property, losses are deductible up to gains. Deduct. And this is up to gains on listed personal property. So losses will carry over. If you don't have listed personal property gains in the current year, they will carry over. And they carry over in Division B, in 3B. All right, so carryovers, I should make that note here. Normally, capital loss, business loss, any type of carry forward where the loss carries forward, the deduction takes place in Division C. So after you compute income. So you compute income in Division B, then you compute taxable income using Division C, remember. So you compute income, use Division B, then compute taxable income, we use Division B minus or plus or minus Division C items. Most loss carry forwards are Division C. The LPP loss carry forward is a Division B calculation in Section 3B. So that's one of the special items that we have in capital gains. All right, so I want to stop with this one. I'm going to try to keep some of these capital gain videos a little shorter so that you can look in isolation, think about it, find aspects of your problems where this might show up, because the problems tend to have a little bit of everything. So go into your problem, see where it might talk about listed personal property or personal property, think about it, and then come back and watch the next video or the video that you think might relate to what you're looking for.